Hey everyone, welcome back to Corporate Decoder. Today ISRL just filed an 8K showing the termination of a material definitive agreement, and it looks like this SPAC is calling it quits. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing really signals the end of the road for its planned merger. This filing here is pretty straightforward. Israel Acquisitions Corp, which is what we're looking at, has formally terminated a business combination agreement. Think of it like a breakup after agreeing to get married. Back in January of 2025, the company entered into a deal to combine with a company called Gadfin Ltd. This deal was supposed to create a new holding company. It involved a couple of mergers to make Gadfin and Israel Acquisitions Corp become subsidiaries of this new entity. The agreement had standard stuff like promises, conditions to close, and ways to end the deal. It was amended several times, mainly to push back the date when everything had to be finished. But as of the 22nd of June 2026, that agreement is officially over. This means the planned merger between Israel Acquisitions Corp and Gadfin will not be happening. Now, there was also a sponsor support agreement in place. This is a deal between the company Gadfin and the sponsor of Israel Acquisitions Corp. The sponsor basically agreed to support the merger. They agreed to vote for it, and there were clauses about donating shares if the sponsor's stake in the new company got too big. They also agreed not to sell their initial shares before the deal closed. With the main agreement terminated, this sponsor agreement and any other related deals also ended. Effectively, all the pieces that were supposed to come together for this merger have fallen apart. For context, Israel Acquisitions Corp trades under the ticker ISRL on the OTC market. Recently, its price has been hovering around 4 cents. This kind of termination is a pretty common outcome for many SPACs. Especially in the current market environment, a lot of these blank check companies raise money with the goal of finding a target company to merge with. But the process is tough, and many fail to find a suitable deal or get it completed before their deadline. This filing essentially confirms the SPAC's original purpose is now null and void. It is a clean break with Gadfin. What this means for shareholders now is that their investment in Israel Acquisitions Corp is likely without a clear path to the kind of value creation the SPAC originally promised through this merger. It is not uncommon for SPACs that terminate their agreements to either try and find a new target if they still have time, or to eventually wind down and return capital to shareholders. Given the recent news about the termination date being extended to the 20th of June, it seems they used up that extension before calling it quits. Looking at the stock price, it is already trading very low, reflecting the market's anticipation of such an outcome. Companies that go through these SPAC terminations often see their stock prices struggle. We've seen similar situations, for example, with other SPACs that couldn't complete their mergers. When a SPAC fails to find a merger partner or the merger falls apart, the sponsor's initial investment might be lost, and shareholders are left with whatever remaining cash the SPAC holds, minus expenses, which is often very little. Per Hesher, some institutional investors like Meteora Capital, LLC, hold a significant stake. This termination means that investment strategy has effectively ended. They will likely be looking at how the company will wind down its operations and what distributions, if any, will be made to shareholders. This particular filing is more of a confirmation of an expected outcome rather than a surprise. For investors holding ISRL, the takeaway is that the planned merger with Gadfin is officially off the table. The filing is signed by Ziv Elul, the Chief Executive Officer and Director of Israel Acquisitions Corp. This confirms that the decision to terminate the agreement has been formally made and reported to the Securities and Exchange Commission, or SEC. Ultimately, this is a straightforward termination announcement. The SPAC pursued a merger, it didn't work out, and the deal is off. It is a common story in the SPAC world, and for investors it usually means uncertainty about the future value of their holdings. The biggest risk here is that the company might not find another deal, or any remaining capital might be significantly depleted by fees and operational costs before any potential liquidation. It really boils down to what happens next with the remaining assets and if any capital can be returned to shareholders. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.